Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host Neena Mishra. My guest today is Christian Magoon, founder and CEO of Amplify ETFs. Christian, welcome back. Great to have you on the program.
Thanks, Neena. It's great to be back. Congratulations on the success of your program. It's fun to speak with you now in the summer.
Thank you.
Instead of the winter.
Sure. So I wanted to start with your SWAN ETF. It's the Amplify BlackSwan Growth and Treasury Core ETF, ticker SWAN. Excellent ticker symbol. And it aims to provide protection against market downturns. And the ETF made its debut on November 6th last year, and I would say that was kind of a timely launch because the stock market was plunging then, and the ETF SWAN did provide some protection to investors during that market downturn. I looked at the performance through the end of the year. SWAN lost approximately 3.5%, whereas the S&P 500 lost 10.5% during the same time period. And I was looking at the performance this year as well. It's pretty impressive. So we'll talk in detail about the performance a little later and the reasons behind those performance numbers. But why don't we start with this? You tell us a little bit about SWAN and what it aims to do.
Sure. So, the word black swan, generally refers to significant declines or in the market due to risks that maybe weren't seen or weren't fully priced in. So we've seen, going back to the launch of SWAN, November 6th was actually election day. Mm-hmm. Some people thought it was a risk that day, depending on who it was getting elected. But we've seen things like a China trade war. We've seen geopolitical events and tensions with Iran and North Korea affect markets. And, this has kind of introduced some new volatility and some kind of up and down movements in the market that we haven't really been accustomed to as much going back to 2008. So the reality is, though, the S&P 500 in any given year, there's a pretty good, percentage chance that you could see a substantial loss. Our data shows from 1941 to 2018, in any given year, you have a 20% probability of seeing the S&P down 20%. You have a 25% probability of seeing the S&P down 15%. So we really wanted to introduce this Black Swan ETF as a way for investors to participate in the S&P 500 returns without being capped, which a lot of products that offer some type of buffer against the downside of the market only allow investors to go up a certain amount in that fund. This approach that with the Black Swan ETF doesn't have a cap. So we wanted to have that participation, but at the same time, we wanted to have a built-in buffer against some of these significant S&P 500 declines, often called black swan events. And we view these declines as 15 to 20% declines. Mm-hmm. And, as you know, demographically, there's many investors who are nearing retirement or who are in retirement who may not be able to stomach that type of decline in their equity portfolio. They may not be able to wait around long enough for that portfolio value to recover until they need to tap it for income. So we think this Black Swan Growth and Treasury Core ETF is a unique product that fits into investors' core allocation, that it gives them participation in the S&P's return on the upside without a cap, but at the same time mitigates that downside risk, some of those larger declines that we historically see of 15 to 20%.
Okay. So, yes, you mentioned market uncertainties, and in fact, there is no shortage of them. China, US-China trade war, trade-related uncertainties, and geopolitical tensions involving Iran. And that is why, even though major stock indexes are at their record highs now, but investors and fund managers, they remain very pessimistic, and they are looking for some kind of protection in case stock market declines in case there is some event which results in stock market declines of 5% or even more than that. So this is definitely a very interesting product. If everything goes well, we get a trade deal and the Fed cuts rate at its July meeting and stock market continues to go up, then investors participate in the rally. But if things do not go well, then it would provide some protection. So tell us how this ETF is constructed and how does the downside buffer work in this case?
Yeah, that's a great question. So the nice thing about the BlackSwan ETF is it's very simple. It only holds two type of investments. So 90% of the portfolio is invested in U.S. Treasuries. And as we know, U.S. Treasuries offer kind of the stability and consistency and income benefits of owning bonds backed by the full faith and credit of the U.S. government.
Right.
This is really the buffer allocation. And as we know, when markets start to get tense, when investors want to go risk off, they tend to go into U.S. Treasuries as kind of the most secure asset in the world. When they tend to go risk on, they go to the S&P 500, the U.S. markets in general. And U.S. Treasuries have a low to inverse correlation to the S&P 500. So you see during times of stress, when the S&P zigs, U.S. Treasuries zag, and vice versa. So 90% of the portfolio is invested in U.S. Treasury securities. They have an average duration of 10 years, and they do produce some income for the portfolio. About 1.8% currently is the yield you get paid, which is not too much different than the S&P 500. The other 10% of the portfolio provides you that participation in the S&P 500, and that is specifically the ownership of S&P 500 LEAP options. So this allows you to participate in the upside of the S&P. These LEAP options are called 70 delta, and really simply what it means is the options will give you about 70% of the S&P 500's return. So if the S&P 500 goes up 10%, you'd expect these options to rise 7%. And because these are options, they tend to have some leverage incorporated with them. And that is really, the ability that allocation provides you the ability to participate in the S&P 500 gains without having a cap. So if markets get tense and we see maybe a 20% decline in the S&P 500, what is likely to happen is those S&P 500 LEAP options are going to trade very low, potentially to zero. Then you still have 90% of your portfolio in U.S. Treasuries. In a decline like we talked about with a 20% kind of decline in the equity markets, we're likely to see money pour into U.S. Treasuries, and we're likely to see those U.S. Treasuries appreciate. So that's how the product works in a risk-off situation. In a risk-on situation, you hold the 90% Treasuries, you're collecting that income that's paid out quarterly from the ETF. In the meantime, your S&P 500 LEAP options, which start out as 10% of your portfolio, can rise in market value. So they could become 15 or 20% of the portfolio. And that's really what gives you your participation in the S&P 500. So as you mentioned, we've been in kind of an interesting market cycle. We launched the fund, the BlackSwan ETF, on November 6th, Election Day. And then through last night, which is essentially June 26th, we've seen the ups and downs of the market, the sell-off in the fourth quarter, the gains from January to May, and then kind of the dip with trade issues, now a little bit of a bounce going into the G20. During that time period, SWAN has had a return of 9.96%. The S&P's had a return of 7.89%. So there's been an outperformance in this kind of mini market cycle, which I think kind of points to the BlackSwan ETF being something that you can hold not just for a rainy day, but something that actually can work in a variety of type of risk-off or risk-on environments. It's really, in my opinion, a new way to apply low volatility investing in an ETF.
Yeah, very interesting. I looked at the performance and I really like that. But this has been a rather unusual year. In the past few months, both stocks and treasury bonds have seen very strong gains because while stocks are rallying, investors are still pessimistic and they are seeking safer assets. But in normal market environment, what kind of performance investors can expect from this ETF? Let's take an example. If the S&P 500 has positive returns, say of 25% through the end of this year, then what kind of performance SWAN would produce for investors?
Sure. So since the ETF tracks the BlackSwan index, we're able to look historically back at the BlackSwan index returns. Now, the BlackSwan is really a quantitative index. There's not a portfolio manager deciding what's in it. It's simply buy 90% treasuries and buy the SPY leap options. So it's very robotic and quantitative. And because of that, we're able to look into some of the history of the index that's back tested. And when you're able to do that, you're able to go back a number of years. So let's talk about some of the good years for the S&P. So the index in 2017 was up 16.7%, underperforming the S&P, which was up 21.8% that year. So that was a good year for the S&P.
Okay.
Another good year historically is 2013, where the S&P was up 32%. And SWAN was up 11% that year. So that's kind of a look at least historically some of the bull market S&P returns. And what happens there with SWAN is your treasuries don't really appreciate, but your SPY leap options do. So you don't participate in all of the S&P 500 returns simply because 100% of your portfolio isn't invested. But we have to look at the whole picture. So let's also look at the bad markets for the S&P. Probably the worst one we can think of lately has been 2008. In 2008, when the S&P was down 37%, SWAN had a positive return of 5.2% that year. Wow. And then even recently in 2018, where the S&P was down 4.38%, SWAN slightly outperformed. It was down 4.09%. So there is some defensiveness that is shown in some of these market declines. One is, SWAN really shines well in a larger, steeper market decline environment, over 15%. However, we see that in shorter-term declines, like we saw November 6th through Christmas Eve of last year, where the S&P was off about 14% from November 6th to December 23rd. SWAN was off just 4%, so it had a 10% performance difference to the positive of SWAN's in SWAN's favor. So, we think this is really kind of a core holding. It should provide a lower volatility ride for equity investors. Over the long term, we're not seeking to outperform the S&P 500, but we're seeking to provide similar returns, but significantly less volatility, and to minimize those major drawdowns that have happened historically with the S&P 500. So far, as the fund has been live since November 6th, we've seen the SWAN ETF deliver outperformance, but as you said, it's been kind of a topsy-turvy market environment over the last 7 to 8 months.
So what are the best and worst case scenario for this ETF? Obviously, the best case scenario would be when stocks and treasury bonds both are rallying. And if the market falls, then maybe investors would lose all the money which has been paid for those leap options, but still get some protection from treasury bond allocation in the portfolio.
That's right. So to get a little technical, the index holds 90% U.S. Treasuries and essentially gets rebalanced around once a year just to manage the duration. And then the SPY leap options are one-year options. So if we think of there's 10% of the portfolio there's two sleeves that comprise that 10%, 5% that go into December SPY leap options and 5% that go into June SPY leap options. So every December and June, half the options are basically expiring, and the fund rebalances and buys more options, 5% worth of the fund value. So and you can actually look on a daily basis at the AmplifyETFs.com website. You can look at the SWAN fund page and actually see how much treasuries and how much SPY leap options are in the fund on any given day. Again, it's a target of 90-10, but as values change on a daily basis, those numbers can change. So if you saw a big run-up in equities, you could see that 10% allocation start to rise in terms of the value of the fund, which means that you'd have more participation on the upside, but you'd also have more risk if suddenly there was a steep equity market sell-off, because you'd have more of your portfolio in the S&P 500. Likewise, if you buy the SWAN ETF after a major S&P 500 decline, you're going to see less SPY option exposure, because the market value of those SPY leap options would have fallen along with the S&P 500, and you'll see more treasuries in there in terms of being probably increased market value, and certainly relative to the SPY leap option. So it's almost like a balanced strategy, how you're trying to own some bonds and some stocks, except it's slightly different because this is really trying to optimize the exposure for a certain risk level.
So how should investors use this product in their portfolio? Obviously, it aims to let investors participate in the market rally, but provide some protection against the downturn. So should this be a small holding in the portfolio? And what should investors expect, and how should they use it in the portfolio?
Sure. Well, every investor is certainly different in terms of risk tolerance and time horizon, but we definitely think that this is a great candidate as a core holding in an investor's portfolio who's seeking to participate in the equity markets, but wants to limit or buffer the drawdowns that typically happen in the S&P 500 over time. Again, these 15, 20, 25% drawdowns that happen quite a bit historically, going back to 1941, but really haven't happened much in the last 10 years. So we see this as a core holding. We see advisors using this in place of low volatility ETFs, where low volatility ETFs seek to provide kind of a similar experience, a lower volatile equity like return. However, we know that 100% of those ETFs assets are in stocks, and we know at times of crisis that the correlation of defensive stocks to the S&P 500 can be 1-to-1, and even defensive stocks can get beat up quite a bit in a severe market event. We saw that in 2008. We think the value or the difference in our approach to kind of this low volatility is that we have two different asset classes, stocks and bonds, and the bonds that we happen to own are at least the perceived highest quality credit in the world, and tend to have an inverse correlation to the S&P 500 during times of market crisis. So we think this is could be a great core holding for investors. There is a distribution that comes out of, again, about 1.8% yield currently per the fund's website. So you can get a bit of an income from this that's kind of similar to owning the S&P 500. And, in terms of groups that seem to be attracted to this, it's groups that really do not want to, stomach, the risk of substantial drawdowns, who maybe are nearing retirement, maybe are in retirement, maybe they're close to, achieving a certain goal, and they just can't wait 3 or 4 years if there's a 20 or 25% market drawdown to get back to that, high water mark. So SWAN will help to buffer those significant losses. They'll definitely participate in the downside of the market, the S&P 500, in a sell-off, but it will be limited in what its downside is, because 90% of the portfolio is in U.S. Treasuries.
Okay, great. Now, I wanted to talk about your new ETF. It is the peer-to-peer lending and crowdfunding ETF, ticker symbol LEND, another great ticker symbol. So tell us what is peer-to-peer lending and crowdfunding, and why you decided to launch this ETF.
Yeah, so we really wanted to launch the fund because we saw an opportunity for growth, and in this market segment. We've been early to identifying other potential growth opportunities like online retail, and we didn't see a fund in this space. In fact, many of the stocks that are top holdings in this ETF are not owned by 99% of all ETFs that are out there. So we wanted to launch this as a way to kind of put a stake in the sand, on a growth opportunity that we think is going to be substantial going forward, not only here in the U.S. but outside the U.S. as really the democratization of access to capital is occurring through online lenders.
Okay, so tell us how big is this market currently and what is the expected growth rate? I understand that this industry is growing very fast, particularly in developing countries where a lot of people do not have access to banking system. They do not have bank accounts, but they do have access to cheap smartphones and data plans. And some of these countries, particularly India, I know that they are very cheap. So people have access to internet and data, but they don't have bank accounts. So obviously, peer-to-peer lending is very important for them. So tell us a little bit about the industry and growth rate.
That's right. So, in the U.S. here, we're all excited if we can see our GDP grow, by 3% or 4%. Mm-hmm. Peer-to-peer lending revenue has been growing annually, going back to 2013 at 51% a year through the end of 2018. So this is now an industry that's generating revenue of $3.3 billion. So online lending is definitely here to stay. It's probably similar to online retail. It just offers so many benefits, whether it's the convenience of being able to get a loan 24 hours a day, 7 days a week from your couch, very quick approval. The selection is superior to going to brick-and-mortar lenders. And then competitive pricing. You generally see lower interest rate opportunities and other types of loans that have different maturities. So we really see strong growth for this industry continuing. Here in the U.S., the industry is fairly new just because the Jobs Act isn't that old, and that's what really created the regulations around this. We expect to see a lot more IPOs coming in the future, not only in the U.S. but outside the U.S., and we still expect the growth rates to be higher in these developed countries like China and India, again, where there's many people who just don't have traditional bank accounts, but they have access to online lending.
Okay, so I'm looking at the ETF and it has 34 holdings as of now. It is a little bit top heavy. Top holding accounts for about 21% of the portfolio. And it is a global growth story, as you mentioned, particularly in emerging markets. This industry is growing very fast. So about half of the portfolio is allocated to developed market companies and another half to emerging market companies. So could you tell us how companies stocks are selected and weighted in the index?
Yeah, sure thing. That's a great question. When you look at the index, essentially it has a couple different sleeves in terms of companies that can qualify to be in the index, essentially an index constituent. And 80% of the portfolio essentially goes into peer-to-peer lending and equity crowdfunding platforms. And these are companies that have to have 50% or more of their revenue coming from loans of either syndicating loans to investors who come onto their platform, or allowing investors to invest in the company to create capital to borrow out to actual people who are the end borrower. So because of that 80% weight into those 50% or more revenue companies, it tends to be a little bit top-heavy because there aren't a lot of those companies out there right now. And when you look at those companies that are most prevalent, there's some pretty big disparities in market cap many of the companies are small to mid cap, but there are a few that are large cap. And that's where you see some of the skew in the weighting, where you see, for example, LendingTree, which I think many of us seen advertisements here in the U.S. LendingTree is the number one holding with about a 21% weight, and it's really due to it being in this pure play segment that's going to be 80% of the portfolio and being such a large market cap relative to the other stocks. So that's why we see a current top-heavy index. We think over time, however, as more companies IPO or spin out, we're going to see this flatten out more. So besides that 80% of the portfolio in these online lenders, we also kind of have some ancillary weightings in providers of technology, software, and solutions, some social networking platforms, and financial institutions that have a dedicated lending and equity crowdfunding platform. So that makes up basically the other 20% of the portfolio. The technology and software solutions, though, kind of is the majority of that 20%, coming in at 14% of the portfolio's weight. So we think this is, a fairly pure play because there's a revenue test, and that is 80% of the portfolio. And when you look at kind of the exposure, it's quite unique, as you mentioned.
Yes.
I think the risks here of this ETF are that the majority of the companies, about 84% of the portfolio, is small to mid-cap stocks. So the small to mid-cap stocks tend to have a lot more volatility. In addition, about half the portfolio is in emerging markets, and they just tend to have a little bit more volatility than developed markets like the U.S. Now, we think this portfolio mix actually makes a great case for the opportunity of these companies because there is, with volatility, increased volatility generally, hopefully becomes, some increased reward, because there's a reward investors generally get for holding more volatile assets over time. And we think that a lot of these companies have some above average growth prospects going forward, and that's why we're seeing them currently being small and mid-cap. They're kind of just starting out. The industry is not that old. And then in addition, we like the volatility of emerging markets because there is that high growth that's happening in peer-to-peer and online lenders in that space. We want exposure to that.
Definitely. So you mentioned that LendingTree is the top holding, accounting for about 21% of the portfolio. And the next two top holdings, Kudian, I don't know whether I'm pronouncing it correctly, and
Legs
and FinTech. These are two Chinese FinTech companies. So I don't know if our listeners know a little bit about them. Then PPDI Group is the next one. Could you tell us a little bit about some of the other top holdings?
Yeah, so, Quidian, QD, is essentially an online lending marketplace that operates in China. They're one of the larger market cap, publicly traded companies that are available in that space. Lexin FinTech Holdings, symbol LX. They do a little bit more than just providing loans. They also do some wealth management and some cash management as well. So they're kind of evolving, as you might think, by first providing a loan and then potentially getting other relationships financially with their individual customers, whether those are retail borrowers or small to mid-sized businesses. Kind of as you go down, Green Sky and Lending Club are also more well-known names, I think, in the U.S. that operate online lending marketplaces. And what's happening is these groups that operate these online lending places have been kind of so successful that they're attracting the mainstream banks now to come in and essentially have these platforms match them with mainstream banks. So where before, some of these platforms were self-funded. They would basically have a certain amount of capital that they would be able to loan out to borrowers and then kind of recycle. Increasingly, there's another business that's developing, almost like an online lending marketplace, where these groups are able to operate these platforms, get the input from the potential borrower, and then go out amongst hedge funds, banks, credit unions, all sorts of sources of capital, and try to match that borrower with the best lender. So they're essentially operating as a middleman, not unlike what Amazon does for third-party sellers or somebody like eBay, where they're transactional. So the business models of online lenders are continuing to bloom, and as you might imagine, Nina, it's going to probably go beyond just lending here.
Yes.
Very likely we'll see some savings potential accounts, maybe some CDs being offered, other types of kind of financial arrangements, because as you know, once you have one financial relationship with an institution, it's a lot easier to broaden that. So this is going to be quite interesting. We think there's going to be a fair amount of mergers and acquisition activity in this space because of the fast growth and the platforms that these groups are building. And the good news is, this should provide, hopefully, more incentive for other companies to come public and be in the portfolio. And ultimately, I don't want to take too much of a ESG angle here, but this really does help democratize access to capital for many people around the world that maybe couldn't get a loan from a bank or don't even have a bank account. And as somebody who believes in capitalism, but often sees some shortfalls in that system, I really think conceptually this could have some great impact worldwide on GDP and financial inclusion, which I think is really important.
Excellent. Yes, I agree with you. This is a growing industry, very interesting concept, and particularly it's a great play on rising middle class in emerging markets where people are getting access to financial services now through the internet. So both very interesting ETFs. It was great discussion. That's all we have time for today. Thanks again for joining us, Christian.
Thanks, Dina. Good to be with you, and take care.
Thanks for listening. If you want to learn more about these ETFs, please visit amplifyetfs.com. Make sure to be on the lookout for next edition of ETF Spotlight, and also make sure to subscribe. If you have any comments or questions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.